Hey everybody, welcome to Trading Capital's exclusive analysis. In this video, we're going to be doing a macroeconomic and technical analysis of what the interest rate projections are looking like, digesting some of last week's employment data, and overall, are there any signals that the bond market is giving us that we can use to trade against? So looking at the 2-year chart, we're first going to start off with a little bit of cycle analysis. Then we're going to jump into the Federal Reserve interest rate projections, and then we're going to digest some of last week's economic data. So looking at the 2-year yield here on the weekly chart, obviously last week we had a pretty substantial fall to the downside, and this has really large implications for the overall stocks, for bonds, for currencies, for crypto, high liquid assets, growth stocks. Everything you name it is changing in the landscape, and we're set for some interesting market volatility. So digesting this interest rate cycle, obviously we had that big run up in 2021. We've now been backing and filling for quite a long time. I want to take you through a 2008 interest rate cycle to show you, based off of using some Fibonacci levels, as to what happened with interest rates in correlation to the overall S&P 500. So throwing up a Fibonacci retrace tool, going all the way back to this 2003 level, throwing it all the way up from the low to your high pivot here in 2006, and then obviously we all know what proceeded after that. But looking at what happened here in the interest rate cycle, I want to bring to your attention this 382 zone here. So the 382 Fibonacci in your previous tightening cycle and then your easing cycle is a very key area to watch. And there's a couple reasons why. When we overlay the S&P 500, which is in red down here, we're looking at this 382 Fibonacci level for a really big area. What occurred in this 382 level on the 2-year yield is what occurred here on the S&P 500 as a double top. So when the 2-year yield hit the 382 here, breaking down, the S&P 500 in 2007 put in a little bit of a cycle top, almost a little bit of a peekaboo breakout double top. So why this 382 area is key, because it's a mathematical retrace zone which ended up causing interest rates to truly implode to the downside. And as you can see, as you started breaking key Fibonacci levels to the downside off of your interest rates here, let's pull this forward a little bit more, you're going to see that the S&P started to fall even sharper. Then you had a bounce in the 2-year yield, and then what happened is a massive waterfall off in the yields caused a massive waterfall off in the 2-year yield, which obviously was your GFC crisis. So let's extrapolate that 382 Fibonacci retrace level to today's price action. So if we throw on, let me just minimize that S&P 500 for now. If we take the low of our interest rate cycle and we throw forward a Fibonacci 382, you can see we're coming up very close to that key mathematical 382. We haven't hit it yet. A couple of attempts here at hitting it, but we're just right at that level of retesting that zone. So the question is, like the previous cycle in 2003 to 2008, if we break this 382 Fibonacci level, are we going to see the S&P 500 put in a little bit of that cycle top? Previous price history is often a strong thing to trade off of, and 2008 is kind of our last true interest rate tightening and easing cycle that we can really rely on in terms of technical price action. So I'm watching this 382 on this key US 2-year yield to really compare as to what that S&P 500 does. Now, this is a little bit of a bearish talk in this video, but overall, I am still showing some technical higher highs in the market and higher lows. So technically the market is still in a very strong bullish uptrend, but we have to recognize, using that previous interest rate tightening cycle and easing cycle, that 382 fib level off of the interest rate 2-year yield is a critical level that needs to be monitored and watched very closely. All right, looking at what the interest rate curve is expecting. So the interest rate curve probabilities of a rate cut have drastically changed as of last week's data. And what is really impressive to note is that now in the September meeting, there's no chance that the market is pricing in the Federal Reserve to even hold. It is pricing in an 89% cut of 0.25% and potentially 11% cut of 50 basis point, which leads me to my next point. If the market is now pricing in a certainty of a rate cut, we look a little bit farther on the curve. What is the October meeting telling us? The October meeting is telling us that there's likely a 25 basis point cut in October, a 71% chance of that. Then there's likely going to be a 20.5% chance of a hold from the September meeting, and there's even a small probability of another 75 basis point cut, taking us to 3.5 to 3.75. So obviously, the market is drastically changing here on the interest rate expectations, and that's going to have a whole host of implications. And why is the market all of a sudden pricing in such definitive rate cuts? The market is pricing in such definitive rate cuts because of last week's data. We got a horrific JOLTS print, 7.38 million, forecast coming in at 7.18 million. Then the ADP non-farm employment change numbers came in drastically lower than what the market was consensus was expecting. If you look at the initial job loss claims also came in much higher than what the market consensus was expecting. So overall, all of the economic data that we got last week was pretty bad, showing that there is an underlying weakness starting to creep into the labor market. You also had the unemployment rate come in line with expectation, but showing a small uptick. This ADP non-farm employment number is very interesting. If we click on it and we take you through the actual data set and show you what has been transpiring, right now you can see that the ADP non-farm employment change number has been printing in some lower highs and lower lows. And you can even see it went negative here briefly. Which brings me to my next point. If we go back to that same 2008 cycle, what started transpiring in late 2007? You started putting in lower highs in the ADP, non-farm employment change, and then you started briefly going negative with a few upticks, but negative, negative, negative. And then all of a sudden, the data started to get tremendously worse as we progressed into the 2009. Now, the issue with this 2009 is this data is lagging. Remember, the market is always forward-looking. So the data in 2008, mid 2008, start to get really, really horrific here in terms of ADP non-farm employment change. But if we look at the S&P 500 in 2008, the data really, the market started to decline in late October of 2007 and then really started to decline into mid 2008. So the market actually topped before the data started to get really, really horrific. So again, if we look at that from a little bit of a longer standpoint, the market, and let's flip back to our SPX, the market topped here in October of 2007. Let's see where the ADP numbers were trading in 2007 October. We were trading roughly around that negative print. The market just started to go negative. So overall, it's telling us that one, the market is always forward looking, and two, the employment data is lagging. So if we move this data forward to today and it's starting to show signs of weakening, are we going to see the markets potentially top? That is something that we need to watch for. When we look a little bit further into the curve, into say the new year, January 28th, 2026, you can see the target consensus for the interest rate, the FOMC interest rate to be, is 3.5 to 3.75%. And if we look at where we currently are, you can see that the interest rate that we're currently trading at right now is 4.5. So if the market by January is expecting us to be at what again? 3.5 to 3.75, this is likely going to be trading at 2.5. There's usually about a 1% differential between where the Fed fund is and where the two-year yield. The two-year yield is more forward-looking than the Federal Reserve watch tool. So again, the market consensus for January is for us to have a pretty big decline in interest rates, which often does signal continued weakness in the overall labor market. So that is just a bit of tidbit of information that we need to digest and consider on the overall macro front. And then we look at that initial job loss claims and we take it one step further. This is also another key metric that, again, the market needs to pay close attention to. But keep in mind, this metric is lagging. I repeat, it's lagging. But what we can deduce from this overall metric is that really since the summer here, midsummer, we've started putting in some higher highs in the overall initial job loss claims. That psychological number of 250,000 is still approaching. Once we take that number out, that is going to be really our first higher high in over a year. Then the next print after that would be taking out and testing this 260,000 area. So keep your eye on this employment data, because if it continues to show a trend of lagging and declining, weakening, the market will likely price certain stocks and adjust appropriately. There's going to be a lot of opportunities where certain stocks can rally, but there's also going to be a lot of opportunities where certain stocks will fall drastically. So just understand we are potentially entering a little bit of a regime change where interest rates are certainly drastically changing, the curve is changing drastically, and therefore the stock market will also likely have to reprice certain assets. So keep a watch of that key critical 382 Fibonacci retrace level on this US 2-year yield chart.